Ashraf Laidi is Chief Global Strategist at Citi Index, and he joins us now. Ashraf, so what is your take on the market moves today? Is this really just a slight technical bounce back, and are we going to continue to move lower, or is this the resumption of the rally that we saw since the beginning of the year?
Well, if you take the equity indices, we have not seen a peak to trough decline of 7% since November. You would see equities coming down 3 to 4% and then coming back up, and the rebound remains intact. We are now around 4% from the recent highs. Do I think that we're going to get back to the highs? I think markets are going to be unwilling to regain the highs ahead of the very important FOMC meeting later this month, which basically, if a simple word will be added, if one more dissenter, in addition to Mr. Lacker, who would disagree with the notion that interest rates have to remain until 2014, and with the Spanish bond yields remaining above 6%, the highest this year, that may show little reason for markets to push back up, and actually for the bears to want to retest, to try to take down another 3% to the downside.
Ashraf, good afternoon. Given your comments and also on the Spanish bond auctions and Spanish bond yields and the Eurozone as a whole, so basically I distill from your comments that your two-year view is essentially bearish for equities and the indices, yes? I shouldn't really be taking anything positive away from that if I had anything from a 6 month to a two-year view, yes?
You asked about the two-year view. Well, let's start with the next 2 months. I think the next 2 months could be quite bearish. The next, if I heard you correctly, if you asked about the two-year view, I would think that if you're going to pursue the argument of buying equities for the long run and trying to select the right individual stocks, that will be the case. But if you look at April, if you look at indices, if you look at April 2011, if you look at April 2012, you would know that this month has not been kind to equities. We've seen a peak this time last year and this time the year before, and we're seeing it this time this year. You look at the relationship with the VIX. What could make things a bit different this time is actually yields are not pushing that much higher as people thought they were because of these concerns these concerns that we're seeing from Spain. Spain being expected could be the fourth country to get a bailout, and with the inability for them to take out 10 billion euros more in austerity, that makes the argument quite strong to attack Spanish bonds as the next victim. So from here until the end of this quarter, we could struggle a bit on the equity side.
Ashraf, the U.S. earnings season so far has been much better than expected. We got numbers from, of course, Alcoa, J.P. Morgan last week, which beat the street's expectations. To what extent can better than expected earnings drive equities from this point on, or do you think this will really just be a side story to everything else that's going on, primarily growth concerns about China and the concerns about the Eurozone?
Net, not much. A short answer to a short question, not, because we still didn't even get into the meat of the earnings. We're sitting into the meat of the technology, and a small, when you look at earnings, you have to look at the sales or the revenues. You have to look at the earnings, the profits, and then you have to look at the guidance. Three elements that each one of them has their own expectations. And we looked at some of the banks, they were fine, but we need to look at the technology. The China story that you mentioned, we actually told clients that there is expectations that we could see the Chinese yuan coming down before the decision to widen the band. Now the decision to widen the band 1 day before tomorrow's important report from the IMF that says that they could be expecting to lower their projections for China's current account surplus from something like 8% to 5%. That could give a very good argument for the Chinese to keep their currency unchanged. A very interesting answer to the U.S., who are trying to insist for the Chinese to revalue. What does that mean? That means that we could see probably lower demand or not so hot Chinese demand for commodities, and that may play probably to the favor of the US dollar at the expense of commodities from here into the summer, especially if the FOMC later this year give us another hawkish surprise.
Ashraf, thank you so much. That was Ashraf Laidi, Chief Global Strategist at Citi Index.